Welcome everybody, it's James Smith speaking here from sunny Melbourne, and thank you for those who have joined us for our May 14 market update. I'm joined by Grant Patterson, and the rest of the Providence investment team are also on the line. And when we get to the Q&A session at the end of Grant's presentation, I'll invite them to join. And so before we commence, we'll just highlight that this is a general advice only, and I just wanted to make you all aware of that. If we move, Grant, to the next slide, I guess we've had a fairly volatile and very interesting couple of months, as we're all aware. And if we think about that and sort of summarise it from an executive point of view, we've seen a rapid move and focus on liquidity to solvency. We're starting to raise the question once again, are we being paid for the risk that we're taking? What is the ultimate earnings impact for companies, both listed and unlisted companies? And that remains one of probably the most profound questions as we continue to work our way through COVID-19, and in particular now with the unlocking or the releasing of some of the more draconian lockdown measures we've all had to deal with in the last couple of months. The huge debt overhang that now is in place over and above what we already had before COVID-19 hit, and the hangover that will leave us both in the short term and very much in the longer term. The new words that will become very commonplace, I would suggest: austerity, frugality, and also caution. The importance, of course, about being diversified and liquid, and really taking fresh eyes on new industries and how things will be placed and positioned, and really how to be invested in what may well be a new paradigm going forward. So with that as a starting point, Grant, I might hand over to you and just really start with the question of how are we seeing things at this point in time.
All right, thanks, James, and welcome everyone. Yes, it's been a stunning period of time. I mean, certainly in my period of time in markets, this has been one of the sharpest falls that I've ever witnessed, and also one of the sharpest rebounds that I've ever seen. Similar back really to a certain extent in 1987, where we got a very sharp fall, only took around 71 days to get to the ultimate low before we started to see a rebound. But you can see from the chart here, in the tech wreck of 2000, it was 600 odd days before we got to the bottom, and in 2007, 355 days. So the caution here is that we've had, incredible speed in markets. It's probably the way the structure of markets are now, with computer trading involved as well. But you normally get rallies within a bear market, and we're a little bit wary of the speed of the recovery of the market bouncing back. And we'll talk a little bit more about valuations, which we do believe matter, just to see where we are after that very big rebound. We're aware that the destruction in regards to the economy has been enormous. Basically, the shutdown of the world's economy. Global growth is plunging, as we can see there on the left-hand chart, and been a total collapse in economic activity. We've never seen such an economic shock of this speed and magnitude, reflecting the significant demand shock that COVID-19 has caused with the shutdown of economies. And the unemployment rate around the world and in the States is simply dramatic and stunning, back really to levels not seen since the Great Depression, with around about 25, 26 million people unemployed in the United States. Now, obviously, the view is that will rebound back once the economy gets up and running, but it's a very high level to start from, and I'd be very surprised to see employment levels back to where they were before we went into this shutdown. And Australian businesses, unsurprisingly, are suffering in business confidence and conditions. And it's really a matter of not what's happening now, but what this might look like in the future. And when when businesses have got such high levels of debt and have had such a big scare, we would think that business confidence will still remain reasonably weak. There'll be certainly cautious sector. I think there'll be a fair bit of austerity. There will need to be some recapitalising of balance sheets to repay the debt that's been built up during this period of time. And the consumer, Australian consumer sentiment, not surprisingly, very, very weak, been hit very hard, back to sort of levels nearly approaching the 1990s recession. It's the last time Australia went into a recession. And so what does that future hold? I think when from the consumer side and from the households, it'll be a rebuilding of savings. Therefore, I think households and consumers will remain quite frugal and remain quite cautious. So I guess in a sense, we're a little bit wary of how quick the rebound might be after such a shock. But the fiscal stimulus has been absolutely incredible. The quantum is unprecedented and dwarfs what we saw in the GFC. We can see here the green bars as the fiscal stimulus as a percentage of GDP in the GFC, and the fiscal stimulus that we've seen from governments now has dwarfed that period of time. And certainly in Australia is leading the world, I guess, in regards to the fiscal stimulus as a percentage of GDP. Over the fiscal stimulus now over 10% of GDP. So the government has certainly gone all out to support the economy as much as they can. And the central banks have also been part of the party, have come in with enormous, stunning stimulus and intervention, with the US central bank balance sheet likely to head towards $11 trillion, numbers that are just very, very hard to comprehend. And also, this has had a big impact on the money supply, the money that's circulating around, yet to go into the economy as such. And there's some dialogue at the moment about whether this huge amount of stimulus and money supply that has been generated, once we come out the other side of COVID-19, will that lead to inflation? At this stage, there's so much demand destruction, it's very hard for the inflation genie to come out of the bottle, we think, in the foreseeable future, but as something that we will be watching.
And just, Grant, with that backdrop, we've always said valuations matter. And just with that in mind, given we've seen the sell-off in March and April and then the fairly dramatic recovery, where are we seeing valuations at this point?
Well, James, they're fair value at best, we believe, after the rebound. If we have a look at the cyclically adjusted PEs of the US market and the Australian market, referred to as the Schiller PE, markets have come back around about to their long-term averages. Maybe Australia's slightly below its long-term average. But we'd argue that the risks are much bigger than what the average has been over the last 10 years. And it really comes down to what you think the E is in the PE. What is the earnings? And there has been some earnings downgrades coming through. We're not convinced, though, that it's enough at this stage. I mean, there's no transparency in regards to corporate earnings. The companies themselves have stopped giving guidance. And the question is, what's the rebound likely to be? The market seems to be suggesting that we're heading for a short-term downgrade of earnings of 15 to 20% in the US and Australia, and then see quite a strong rebound or a V-shaped recovery. We find that pretty hard to believe, and certainly if we have a look back at GFC levels, you know, the earnings downgrades were much more severe. And where the market is at the moment, we can see that consensus analyst estimates have got earnings falling down from 157 to 139, but then a very strong rebound, up 38% by 2022. And that's quite that'll be quite a big ask, we believe. And of course, the earnings downgrades across the market has varied quite substantially, with technology, utilities and consumer staples holding reasonably steady on an earnings basis, but energy, industrials, financials, consumer discretionary, all been hit pretty hard. And the rebound that we've seen in the markets has been pretty narrow. I mean, the resurgence in the US has been led by basically, well, 5 stocks accounted for 20% of the resurgence in the market. So it's not terribly broad. It's very narrow at this stage. So in trying to find levels where we think the market might represent good value, current earnings expectations are for a 20-odd% fall in earnings. This is in the US, followed, as I mentioned, by a 28% rebound in 2021 and a further rebound in 2022. Under this scenario, the equity risk premium, that is the premium above the bond rate that you require to buy equities, would be around 7% against an average of 5.6. However, during the GFC, we saw earnings down some 40% and an earnings risk premium around about 7. If we got the same type of earnings downgrades and a slow recovery, that would give us a buy level of the market of about 1890, which is a long way from the current level, some 30% below where we are at the moment. If we take a more positive outlook in regards to the recovery, still having the earnings downgrades but a V-shaped recovery, then the S&P would look attractive buying around the 2380 level, which is 15% higher from its current level. If we also have a look at the long-term average forward PE of the US market, which has been around 15.5 times, and saw that earnings downgrade come through, that gives us a target of 2200 on the All Ords, which would be down 20% from its current levels. Now, these shouldn't be taken as absolute levels or absolute numbers, but what we're trying to say and feel here is that there is still a lot of risks around what the earnings are likely to be, and therefore we would like to see more visibility before committing capital. This is pretty much the same for the Australian market. In fact, even is a bit more negative given the structure probably of the Australian market. But you can see the targets there. If we go back to the GFC levels, if that's a guide, and I know every time is different, if we see a 40% fall in EPS and we still want that higher equity risk premium to compensate us for the risk, there is still some substantial downside in our view to the Australian market. So whichever way we look at it, we do not believe that equity markets after their rebound look attractive values. In fact, what we feel has been happening is that we've had very much a liquidity rally, a bit of a relief rally after the central banks have come into the rescue of predominantly the corporate bond market. And we've seen a bit of a relief rally there. But valuations now don't look attractive enough for us to commit capital to the markets.
And sorry, Grant.
Yes, Daz.
I was just going to say, in terms of other asset classes, how are we seeing those at this point as well?
Well, when the market had its initial sell-off, the thing that was intriguing to us was that all assets were sold. Didn't matter whether they were defensive or aggressive or risk assets or whatever. Gold, government bonds, equities, property trusts, everything got sold. And that was a liquidity-driven event where people just searched for liquidity for wherever they could find it. And in the listed property markets, that was one of the hardest hit sectors, fell further than the equity market. And what that's done since then is it's it is at a level now where implied cap rates have moved from around about 5% up to around about 7%. So that would indicate a decline in values of the underlying property in the order of 15 to 20%. And we're certainly hearing now that vacancy rates for office in Sydney and Melbourne are likely to top 10 to perhaps 15%. So that's going to have an impact, obviously, on rental income. And we've also seen the same in the retail sector, whereby rents have been renegotiated for a longer period of time at much lower rates. So we'd be expecting a valuation hit, I guess, to some of the direct property exposure. But it seems to us in the listed market anyway, that a lot of that bad news has now been factored in to the share prices of the A-REITs. They are not heavily geared, and so it's our feeling that, and we're doing a fair bit of work on that now, that the ongoing softness of the economy has been pretty much factored into share prices. When we have a look at corporate credit, this is an area that we've been very concerned on for some time, given the extraordinary debt levels that was building up in the corporate sector. And as people chased yields, the quality of that debt declined. And we were very concerned about that market. When we saw the downturn in February, basically the credit markets froze. There was no transactions going on. And in fact, in the government bond market, in the UK, the gilt bond auction nearly failed. And that's when the central banks came in to the rescue, and the US Fed indicated that they would buy high yield bonds and support them, which gave a big rally to that market. However, where we are now is that there is still this enormous amount of debt around, and there's obviously been a big hit to underlying revenues. So if we have a look at the high yield bond market, for example, if we go back to GFC levels where you get defaults in the order of 10 to 12% and recovery rates of around about 40, that would wipe out about the whole coupon that you get for owning these bonds at these sort of levels. So once again, we think there's been a relief rally here, but we're not quite sure yet that they represent a very good value, and certainly nowhere near the value that we saw coming out of the GFC. So global debt levels still remain elevated in all areas. Households, corporates and federal state borrowing in the US, for example, as a percentage of GDP, looks like it's heading up towards 300%, the highest rate we've seen since the war. And that's something that is going to remain for some time and be quite a hangover for many, many years to come.
And in terms of other areas that we're watching, Grant, outside direct assets or particular asset classes?
Well, James, the oil price has obviously been quite top of mind, seeing a negative oil price at one stage, which is just extraordinary. Sometimes I think you have to pinch yourself to realise what we're witnessing here. And certainly we've taken a lot of time with our investment committee trying to make sense of a lot of these moves. But the oil price has fallen quite substantially, bounced back a little bit. But I think the thing to keep in mind is that, especially in the Gulf states, I mean, their fiscal balance and budget relies on the oil revenues that come through. And the fiscal break-even price for most of the countries in the Middle East is over $40, $40 or $50. So there's a real issue for them having this oil price stay as low as what it is, and we'd expect some further response from the Gulf countries.
Do you have a
try and
slide
address
there
that.
you can show us, Grant, just to sort of to sort of
Sorry.
pictorialise that?
So there's the break even barrel of oil, and as you can see, Saudi Arabia needs circa more than $60 oil price to break even on its fiscal balance. And of course, the US shale industry, which is in absolute turmoil at the moment, and we're expecting an enormous amount of defaults, requires a $50 to $55 barrel of oil. The other area that we've been watching, James, is the Australian dollar. As you may be aware, that most of our international equities have been held in offshore currencies to try and protect the portfolios in the event of a sell down, which would normally see the Aussie dollar sold down. And that's certainly what we saw in March. So in March, the Aussie dollar got down to a level which is well below its 10-year average as a real effective exchange rate. So we took advantage of that, and we've partially hedged our international equities back into Australian dollars, and we're going to have a look at whether we hedge all of those international equities back. But certainly that strategy protected to a certain extent the holdings that we had in international equities.
And if we think, Grant, as we wind our way through the 20th year of preserving and protecting capital on behalf of clients, if you were to reflect on some of the learnings and putting those learnings into consideration of what those 20 years have taught us, and putting that into context with the environment we find us in now, what are some of those key reflections for you?
Well, the thing that comes to mind quite often is it might be different this time, but the result will be the same. And what I mean by that is we believe valuations matter. And ahead of the COVID-19 breakout, we were very concerned where valuations were, and we do believe that valuations eventually mean revert. Now, COVID-19 came along, which was a trigger to see those valuations rebase. But it's something that we always focus on. You cannot time markets, and you need to be very humble with the markets, because the markets can have a mind of their own for a period of time. And there's quite a lot of behavioural bias that occurs in markets with the herd mentality. And I think we've seen some of that just recently when the market had the big fall and started to recover. There was an enormous amount of new accounts opened in retail stockbrokers, 3.5 times the normal amount. This is people believe that the rally, we'd seen the low and were chasing the rally. So I'd be cautious and always try and have a feeling for where the behavioural bias might be in markets. It's very important to make sure that you've got liquidity when you need it. The advantage of having the liquidity is that, number one, that you're not fretting and worried, but most importantly, you're able to deploy that liquidity when there's stress and take advantage of very cheap assets. I think the benefits of diversification has been shown out during this period of time, where our portfolios have held up very well given the diversity in the portfolios, and it's been able to reduce volatility. And we are still the most diversified we've been in our 20 years and expect to remain so for some time, given the lack of clarity and the uncertainty that's around in all asset markets. And I think the other thing that's taught us is you need to be patient. You need to do your research. There's plenty of time hopefully ahead of us, and therefore it's a matter of being patient, waiting for those opportunities when they come around. And I'm sure that in the months and years ahead, there will be many opportunities, particularly in some of the stressed areas, whether that be distressed property, distressed debt. There will be opportunities, but you need to come from that with fresh eyes, not from the recent past.
Thank you for that, Grant. We might now open it up to Q&A. So for those that didn't hear me at the start of the webinar presentation, either at the top or at the bottom of your Zoom screen, you'll see a small icon that says Q&A. If you click on that, that gives you the ability to ask us a question directly, and I'll work our way through over the next 5 or so minutes, 5 to 10 minutes, with some of those questions that have been put to the team. I'll now also invite other members of the Providence investment team, Michael Ogg, William Porter, Harry Buckeridge and Carlo Kudeng, to join as panellists, so we can refer to those with some of the questions. So please feel free to ask the questions, and we'll get through them as they are logged. I'll just start with the first question here, Grant. Has the hedge added any value? So I'm guessing that's referring to the hedge of some of the international exposure with the Aussie dollar back when the Aussie dollar was around 60 cents?
Yes, well, it has. It certainly cushioned the blow. I don't know, Carlo or Mike, whether you've got to hand what the quantity of that would have been in regards to having our equities, offshore in offshore currency, but it certainly cushioned the blow. Most of our international fund managers also were value driven, so they tended not to have the full downturn to the market. But the hedge has certainly worked very well for us, or not in international currencies. We've only sort of changed our stance in the 20 years on 2 or 3 occasions. And when we first started, the Aussie dollar was, back then, 20 years ago, was around about 55 cents. And we thought at the time that, not thinking about where the dollar would be, tomorrow or the next day, but that seemed a pretty low level to us. We felt 50 cents would be the floor. So we hedged 100% of our international equities back into Australian dollars. When the Aussie dollar got up to parity, we felt that we're getting a bit long in the recovery. We felt that the dollar was towards the top end of its range, and on a risk-reward basis, that's when we decided to take the hedge off. Of course, the currency went straight to 108, but we've kept that stance all the way through. And once we got down below 60, we decided it was time to hedge half of that back.
Thanks for that, Grant.
Just on the numbers there, Grant, the fund managers, the international managers, were down around -6 for the quarter on balance, and the benchmark was down around -10. So it did add value over that period for the quarter.
Thanks, Carlo.
Thank you, Carlo. Next question is, where are the opportunities given the risks seem fairly widespread?
They're hard to find or hard to commit to. So what we've been working on, we've been looking quite a lot of opportunities that come up over the last 5 or 6 weeks. We haven't progressed with any of those at this stage. We are attracted to the domestic tourism opportunities that may come out of this. There will be some stressed assets in regional accommodation, and that is something that we're still actively pursuing. We also are quite attracted to first mortgage fully secured loans. Those spreads have blown out now, backed by physical property that you have first mortgage and fully secured over a completed dwelling. So that looks attractive to us at this stage. But that's about, and as I mentioned previously, we're having a look at the A-REITs, whether there's some opportunities there where all the bad news has been fully factored into share prices.
Thanks, Grant. Another question here is, given the environment of zero interest rates and the massive stimulus packages we've seen across the globe, why do valuations still matter if the central banks are going to ride to the rescue at the first signs of financial trouble? So I guess that brings the question back about the Fed put, if you like, in terms of the backstop of central banks for time immemorial.
Yeah, it's a very good question. And, certainly the markets have got the right to feel that the systemic risk has been taken off. The central banks will be there. But ultimately, an investment is all about the future cash flows that investment is going to generate you. And in a very low interest rate environment, it's very hard for companies, and particularly banks, to grow their earnings the way the economies are looking. And therefore, although on the basis of the discount rate being so low, you can push your valuation metrics higher, and with the Fed there, providing the put, that can give you some confidence. But eventually it comes down to the cash flow that those assets are going to provide you, and that's where valuations do matter, irrespective of whether the Fed's there or not. So it may protect your downside. I mean, there will be a limit to how much the central banks can buy, and even their support of the high yield market. It's a percentage of the debt, not the total debt. So I take the point that with the Fed being there to support you, with the low interest rates, you can justify a higher PE and a higher premium, but I still think it comes down to what cash flows are going to be generated. And I think it's really interesting. One thing that sort of we've been watching, we've had very good recovery in the markets, yet global banking stocks are still towards their low, particularly in Europe, but also in the US. So the banks have not recovered and participated. And I think that's telling us something about the economies. In the GFC, we had a Fed that steepened the yield curve, which enabled banks to recapitalise their balance sheet because of the margins that they were being able to extract out. At the moment, we've got a very, very flat yield curve. The yield curve is not saying to us that there's a very strong recovery coming through, and the banks' share prices are reflecting that.
Just with that in mind, to perhaps broaden that a bit, specifically a question on the banks, and you're suggesting that the bank share prices don't reflect an improving trend, but specifically our view on the banks at this juncture?
Well, Harry, I'll ask Harry to come into that discussion. I mean, Harry and I have been talking for some time about, is it time for the banks to to look at the banks. We are underweight the banks at this stage. We're remaining so. We're watching it pretty closely. But Harry, I'd be interested in your observations. I know you've been talking to a lot of people around the markets, and how do you see the Australian banks, particularly with the cut in dividends and the lack of growth?
Yeah, sure. It's a good question. I think you touched on the right subject in terms of flat yield curve and the impact that has on bank earnings, because that is one of the big pricing variables that the market's looking at the moment. I think the other one that's really interesting and that's really being focused on quite heavily is bank balance sheets and capital. In a downturn scenario, one of the more important things the market looks at is a bank's ability to withstand a downturn, and rightfully so. The sort of short answer is we think Westpac, NAB and ANZ we'd put in the hold category, not just because we do hold them, but also because we're not quite ready to buy more at this stage, given we are underweight the banks. CBA has the best capital position of the big four, and that's where we see the most comfort. At this stage, what we're really waiting for is not just that yield curve to steepen that Grant mentioned, but also to get a better read on the risks that are inherent in their loan books, and particularly as we get to post-reporting season and closer towards the roll-off of JobKeepers, if the government tries to accelerate the transition away from JobKeeper, and what that means for mortgages, and how those bank credit provisions basically stack up against their assumptions of what the economy looks like over the next couple of months, because that'll dictate what their capital position looks like in the medium term.
Thanks for that, Harry. A few more questions here. How does Providence see the impact of changing geopolitical circumstances?
Oh, well, we rely on our esteemed investment committee member, Jonathan Payne, to advise us on the geopolitical side. Look, I mean, it's just something that concerns us or worries us, but it's very hard to, change investment decision making on the back of, those unknowns. I mean, I think certainly in the 30 or 40 years I've been in the markets, there's always been a geopolitical issue somewhere, at some time, and it's very hard to, make informed investment decisions on the back of that. I mean, directly for Australia, the relationship we have with China is obviously very key in regards to our exports, and we're already seeing tension in that area. I think both China and Australia need each other, and therefore I think a pragmatic solution will come out at some stage after all the posturing. And we've got obviously a very unpredictable character in the largest economy in the world. So we watch, we make sure we've got enough diversity, we make sure we're not concentrated in one area to try and deal with those sort of risks.
And I guess, Grant, that comes back to the point at this juncture, there's just still so much lack of visibility in how things will play out in the coming months and indeed maybe in the coming years. And that just brings back that whole point about the valuations matter that we discussed earlier in the webinar. The next question is, have we become too short-term in our thinking? I don't know if that's a Providence specific question or whether it's more broadly, but I'm sure you'll have a response to that.
Well, I note that we were talking about the number of retail investors starting to come into the market, and I noticed now the average holding period for a stock has gone to 1 day, so that is very short term. Look, I think yes, there's a lot of noise around, and therefore it's very easy to make decisions on the short term noise. We try and avoid that and have a look at the longer term picture. I mean, I was interested in Warren Buffett's annual meeting just recently, who's the proponent of investing equities for the long term, don't worry about the short term noise and what have you. However, despite having 124 billion on his balance sheet, during the sell down, they were net sellers of stock, which intrigued me, given he is a long term investor. So the market is definitely too short term. The market, in my view, is trading on the narrative rather than the fundamentals. So it's trading on what the central banks say, it's trading on what the algorithms are doing and the computer trading and the day-to-day stuff. The volatility is something I haven't seen in 40 years on a day-to-day basis. It's extraordinary. And I get up in the morning, it doesn't surprise me whether the market overseas is up or down, 5% or 8% would not surprise me. So I think the market is too short-term focused. I think share prices have no relevance at the minute to long-term value. And once again, whether it be equity markets or property markets or your debt, we're just trying to have a look at what the long-term cash flows are likely to be and what short-term impairment might be on the way through.
Thanks for that, Grant. We've got 2 more questions here and then we might wrap up the session for today. The next question is, do you see Providence moving towards an overweight or an underweight in international equities?
Well, we prefer international equities to Australian equities, given the much broader opportunity set. So international equities are likely to remain preferred over Australian equities, which we've had for some time. if valuations get to a level where we think they're attractive, yes, we have no problem about going overweight international equities. I tend to think we'll probably look at credit first once we get some stress, because I think you'll get equity-like returns for credit-like risk, and that was certainly our experience. On Mike, Mike in GFC, when we went through that period of time, we had a lot of cash, and then we just deployed the assets. Mike, can you recall sort of?
Just on the credit, it's interesting. We're currently talking to some overseas guys in distressed credit, and they're looking at average returns of 15 to 20% IRR in that space. So, I mean, that's very equity-like, and that's certainly an area that we're looking at the moment. Yeah,
and that was the experience in the GFC when we had, luckily, 35% or plus cash. Once the GFC sort of came through, from recollection, the first asset we bought was credit because you were getting equity-like returns. The second asset we bought was distressed property because the super funds had to sell anything that they could to shore up their liquidity, which we may see again down the track. And the last thing we actually did was bought equities. So I suspect that we might see the same sort of pattern this time around.
Thanks, Grant. And the final question relates to stimulus funds going into renewable energy projects. And the question refers in particular to Queensland, but broadly the question's asking, are there any investment opportunities within renewable energy opportunities?
Well, I'm sure there is. There isn't something that we've got on our plate in front of us. We are definitely having a look at infrastructure as a general comment, with an environmental overlay. With the renewable space, it's going to come down to the cost of building that. But I think as a sector, and this is why we need to be, have fresh eyes. I think as a sector, we're definitely going to see government fiscal spending increase across infrastructure, and that should, support growth. As I mentioned, we have been, having a look at those sort of opportunities, but at the moment, there's nothing that's on our immediate radar screen.
Okay, thanks for that, Grant. There's no more questions. So with that, we might wrap it up. And on behalf of everyone at Providence, we'd like to thank you for joining today's webinar session.
Thanks, everyone, for joining us.